Good morning and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Chris White. He's the CEO of ViableMkts. And we're going to focus on corporate bond market transparency. Thank you very much for joining us
Morning,
at
Jill.
MarketSite today. And this is an interesting topic to dig into that I hope you can lay a framework for us here. But tell us about the new proposal by the SEC Advisory Panel on large bond trades.
Sure. So earlier last week, there was a meeting in which this pilot program was introduced, in which the committee was basically suggesting that in a pilot program, the reporting of trades of a certain size, the really large trades of 10 million above in investment grade and 5 million above, should go through a delay in terms of the reporting of when those trades occur. The delay that they suggested was 48 hours. Some other details in the proposal is that the trade cap, we've had trade reporting on transactions in the corporate bond market since 2001. The initial framework, the framework that's out there today, caps the reporting of a trade of significant size at 5 million. They said move the trade cap up to 10 million in investment grade, and for high yield, it's capped at 1 million. They said move it up to 3 million. So it was a little bit interesting because while they're asking for a delay in the reporting of these really large trades, they're also asking for more details around bigger trades. So,
so what are money managers and the bond dealers saying about this?
You know, I think that this is going to be, this topic on data in the corporate bond market is going to be front and center for quite some time. I think there are two camps here. I think some of the larger players in the market like the idea of less information out there about really large trades. There was some data actually put into the proposal that was quite interesting. From 2013 to 2017, trades that they're looking to delay reporting on accounted for less than 3.5%, of the transactions in the marketplace. But in the investment grade market, they were 55% of the volume. So you're talking about these massive trades that are occurring. Now, what's interesting about the data that was shown in this report is it really doesn't break down the block trades, these super block trades, by maturity. Because in the bond market, a quirk is obviously how much time is left until the bond matures. So doing an $100 million trade in a bond that matures in 3 months is actually less risky than doing a $5 million trade in a bond that matures in 30 years.
Right.
So I'd like to know a little bit more about that data. I'd love to know how much of these super block transactions are occurring in long-dated trades, because I think it's probably a really small universe of trades that we're talking about here.
This is where I have a hard time wrapping my head around it. In today's regulatory environment, I'm not quite sure what they're thinking about giving a 48-hour delay, or is the transparency argument being ignored over liquidity? This is where I'm confused about.
Right, and you're right to be confused on this,
Right.
because I think if you're coming from more evolved markets, this idea that if you took data away, liquidity would somehow flourish is one that just seems really strange.
Right.
And actually, that's when I'm looking at this rule, that's one of the things I'm asking. Where can you cite an example where doing something like this has actually brought more activity into a market? I think what's happened here is that because trade reporting has been really the only transparency initiative introduced into the corporate bond market almost in the past 20 years, any issues around liquidity are being blamed on
Right.
transparency, right? When actually I think that the problem around trade reporting is not the reporting of the trade itself. What we really need to examine is the entire process for institutional block trading. And the reason why this needs to be examined is, despite the fact that the market has doubled in size since 2008, we've seen stagnation in the frequency of block trading. So this should be concerning for the marketplace. It's literally been a flat line if you look at trace data in terms of trades of significant size occurring in the marketplace, even though there are so many more bonds.
So what's your opinion? Do you think that this pilot program could potentially help make the road more clear for regulatory framework, or you don't see this being successful?
Well, I think there needs to be a broader discussion. Mm-hmm. Like what's completely absent from this discussion is what is the current state of pre-trade data in the institutional market? And I think that's actually where the problem starts for trading. The lack of high quality pre-trade data in the institutional market is creating a really large degree of uncertainty. This uncertainty grows as the market gets bigger. And what we've seen in markets is when there's uncertainty, people tend to pull back in their trading activity. So to me, the theory it's pretty clear. We're having a liquidity issue because we don't have enough data. It's not we're having a liquidity issue because there's too much. So I'm hoping that there's some deeper thought around a pilot program like this, because a couple of things that we've never tried have been like, well, what if there was better reporting of the bids and offers for block trades out in the marketplace? Could that potentially bring liquidity in the market? It certainly worked for Nasdaq almost 45 years ago.
Well, you know what? It's going to be interesting to see how this conversation evolves, for sure.
Absolutely, and it's always a pleasure, Jill.
All right, thank you very much, Chris, for joining us. And traders, thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.